Well, good morning, everybody. This is Mauricio Salinas, Elite Capital U. Friday, September 1st. September 1st. Oh my God, where am I? September 5th. We are going to be doing a pre-market analysis. We'll be here for about an hour or so, give or take. SPOOS, S&P 500 futures, reaching all-time highs overnight. This is a move that was expected based on God knows what. News is news is bleak at best the way I look at it. But I guess when the market wants to run, the market wants to run. All-time high is a very psychological level. People want to reach it. People want to breach it, and I guess that's just the way it goes. So. We're looking at a 30-minute chart. This is the overnight session for the S&P 500. This is more or less where we left off yesterday. I'll go ahead and highlight the overnight session so everybody can see it. Here we go. We had a trend day yesterday. That was something that was expected. We actually planned for this in the morning in the pre-market yesterday. We actually traced the levels that we thought the market was going to be hitting consistently throughout the day, and it actually played out beautifully. So these are the levels from yesterday. We basically had an inside pre-market session yesterday. That was the settle from from Wednesday. Market open, tested that settle, tested it overnight. So obviously there's some importance to the level. That was the settle for the week. That was our weekly pivot. And then from there, we just ran to the upside. We hit the risk marker from Wednesday that had not been reached. Then we hit the risk marker for yesterday. And once the overnight market hit the all-time highs, that was all she wrote. So we're basically staying above the risk marker from yesterday and the overnight high. One thing to remember is that the market more than not always goes to test overnight highs, overnight lows, especially if they're all-time highs. Based on liquidity, these levels usually are tested in the morning right after the market opens. From a liquidity standpoint, and they also help us to see how confident is the move that the market had in the morning. Okay. Good morning, Julie. Julie, thank you for joining us. If you have any questions, please type it on the chat. This is the way that we trade is very different from pretty much everything that you used to seeing on TikTok and in many other places. Everybody talks about technical analysis and scalping on the 1 minute or the 2 minute chart. Very few people talk about swing trading. There are some people that do. But we do not trade this way because that is realistically not the way that institutions trade, and we are institutional traders. I did run a prop firm for about almost 10 years, and now we're doing this. So whatever we teach here is pretty much like they said, it's how things really happen in the street, in the institutional world. We look at levels. We look at levels just like you guys do, but we cannot look at levels that are created by the market, not so much by technical analysis in the past. We do look at some of those levels. We do look at some other stuff, but realistically, mostly we base our decisions on the options market, which is what drives the market. Okay. What else are we going to look at today? Oh, well, let's see. First things first. This is how we do our prep. Every morning, it's like an old song. I mean, it just gets old because you play it over and over and over again. But one other thing about this business is consistency. It does get boring. I will admit to you, once you learn this business, you learn it the right way, it becomes very, very, very mechanical. You do the same thing over and over and over again, and that is what's going to bring you results. If you're jumping from strategy to strategy, from system to system, looking for the Holy Grail, I will tell you right now, I've been doing this for over 15 years. There is no such thing as the Holy Grail. Everything works until it doesn't. Some things work better, some things don't work. But that's that old saying, anything that can go wrong will go wrong. For the market is anything that can go wrong will go wrong. at the worst time. And I've been, and I can tell you stories about that. So the first thing that we do when we wake up in the morning, obviously, is we look at the pre-market session. What is the pre-market session? The pre-market is basically whatever happens in Europe, whatever happens in the Asian market, in the European markets. Why do we look at that? We need to understand that again, and I think I said this yesterday, and I'm going to say it again today. We are in a worldwide economy, and the buck doesn't stop with us. Yes, it is the biggest economy, but yet the whole market trades. It's not just us. So we do take a look at what these people do. Does it give us an idea what the market is going to do today? Some people say it does, some people say it doesn't. We take it with a grain of salt. And the reason why we take it with a grain of salt is because we don't have liquidity on the overnight market. What is liquidity? Well, liquidity means volume, participation. I mean, if you look at this, I mean, I even have to bring this up. If you look at this right here, that is the volume that we see on the regular trading hours. What are regular trading hours of the cash market? 9:30 a.m. to 4 p.m. Eastern Standard Time. Overnight market, or the Globex market, or the European session, or there's different names for it. We're just going to call it the pre-market or the overnight market. Is from 6 p.m. until 9:30 a.m. That's Monday through Friday. The futures market does open on Sunday at 6 o'clock because Europe is ahead of us. So when it's 6 o'clock in the afternoon here, in Sydney, they're actually getting to work, which is the first market that opens. Actually, it's another one, but we just look at Sydney. But if you look at the volume that we have in the overnight session, there's nothing to compare. So this is a cash market, overnight session, not much to do. Buenos días, Luisa, ¿cómo estás? We are going to be paying attention to this level that was hit in the morning because that is, again, an all-time high. So when we see these things happening in the overnight market, we start framing the kind of day that we feel we're going to have. It's not about just looking at random levels in a vacuum or looking at technical analysis levels like higher highs, higher lows. Yes, that does come into play. But if I see that an overnight high was made and it's an all-time high, and I know that that high was made on low volume, no liquid, in a non-liquid market, there's a very high probability that the high is going to be tested again. So that started giving us like a bias, maybe not straight at the open, maybe throughout the day. And if it doesn't get tested today, it's a level that we have to carry forward. Carry forward is a term that you're going to hear me say a lot because there are levels that are important that we know the market will test. Maybe not the same day, maybe in a week, maybe in 2 weeks. But if you know that level exists, when it does, when the market does come to test it, it's not going to catch you by surprise. Hi Mia, good morning. How are you? Let's see. Okay, so we looked at that. The next thing that we're going to look at to see how strong this high was, we're going to go look and check volume. The volume on the ES to see how many contracts were traded. It's very important because volume confirms or denies the actions of the market. Price is an advertising mechanism. Price is, I know everybody follows price and price here, price this, price that. We don't. Actually, we only traded 89,000 contracts. This is actually even less than yesterday. Yesterday, around the same time, we had traded about 101,000 contracts. So that's another bias for me to say, okay, we might open, we might test the high, and the market might just drop because the volume is not there to support the move. You cannot make all-time highs on low volume and expect that level to hold. So it would probably get tested again this morning. So we have, so right now we have about 90,000 contracts for this morning on the ES. We also go look and check what is happening on the bond market. Why the bond market? Because the smart money is in the bond market. Always has been, always will be. Active contract, we have about 69,000 contracts traded. That is a high number, almost as much as the ES. So yeah, we have some skin in the game today. We looked at volume. We looked at the European session. We looked at let's see. Let's look at the levels from yesterday. So we looked at the levels from yesterday, and let's pull out a little bit and get into a higher time frame so we have a better idea what's going on. I like to say that I like to get out of the woods and get into the highest tree to see what's actually going on. So that was Tuesday. That was actually, let's see, the 29th, Friday, Tuesday, Wednesday, Thursday, and this is today. We're looking again at the overnight session. We made an all-time high. Momentum is kind of flat. So again, another indication that this high may not hold. We might just get tested and just come back and run out of it. Once we finish looking at the pre-market, basically the action that it took, the volume and all that stuff, we're going to come back and we're going to trace the levels for the day. What are the levels for the day? The first one that I'm going to retrace obviously is going to be the all-time high because that level did change. So we're just going to activate the drawing. Actually not activate it, we're going to edit the drawing. I am using Thinkorswim. If you have any other platforms that you like to use. Hey Rufy, how are you? Thank you for joining. And if you guys have any questions, please type them on the chat. So we're going to change this all-time high because this is a level that we do have to keep in mind. And again, if it doesn't get tested today, we have to keep in mind that it might get tested in the future. So that is going to be 9/5, August, September 5th to the 30th. So okay, that changed. So that level is going to be there. Again, what other levels do we look at? Well, the overnight high is the same as the all-time high. The overnight low is basically at the same place where we have the risk marker from yesterday. What are risk markers? You keep hearing me say risk markers. Many times you will see the market run and it will just literally stop dead on its tracks, and there's no rhyme or reason why. And people think that the market trades in a vacuum, that there is nothing, I hate to say the word controlling, but there are limitations as to how much a market is supposed to move based on the options that are being traded, specifically on the SPX. What is the SPX? The SPX is the S&P 500 index. Why do we look at the S&P 500 index? Because this is the biggest product that we have. It is a huge product. It is very, I hate to say expensive. It is very pricey to trade this product, and it is also very risky. It is very volatile. To tune that, you need in my opinion, if you don't have at least $100,000 trading account, you shouldn't even be touching this product. That's basically how risky it is. If you guys trade options, anybody that trades options, let me give you an idea what this bad boy cost, and it'll be nice if you would open. So let's say an option for today, we have 0DT. I know there's a lot of people that love to trade 0DT options on this contract. And let's say we just buy this one right now. I mean, this is going to cost you about $2,400 without commissions. Including commissions, you're looking at about $1.22. So yes, and this thing does move. It moves fast. It's like the Fast and the Furious. You need to be very careful. So why do we look at this product? Because institutions trade this product. They place risk on this product. They hedge positions with this product, and also the majority of what they do is they sell premium on this product. When I mean selling premium is they sell either calls or puts, whatever it may be, and they take that money and then invest it or buy other calls, other puts, or make plays for stock, that they might have on their books. It is a very convoluted process, and as we get more into how institutions trade, we will have classes, and we'll have lives to kind of explain to you guys how it works. Basically, for today's purpose, institutions sell options in the S&P 500 based on that risk that the institutions have placed with their positions. When they sell, there is a range that is created for the market for that week or for that month, even for a day. So the range for this week for the SPX was between this line and that line. That is what was dictated by the options market. We have X amount of trillions of dollars in play, And as long as the price stays within this block right here, these people are collecting premium. What is collecting premium? When you sell an option, you get paid up front. When you buy an option, you have to pay for it. What is the difference? There's a huge difference, of course, but the main reason why institutions sell options and to create cash flow, number one, and number two, we're collecting time. I mean, basically, when you buy an option, you are on the clock. That position really has to work very fast, otherwise the theta component will start eating your option away. Then people say, well, I buy time. That is all fine and dandy, but if you don't know how your Greeks works, then you will know that Vega, which is your implied volatility, will eat away at your premium. This business was designed to take your money, specifically the options contracts. About 90 to about 95% of contracts expire worthless, meaning that they never made it to being in the money. Yes, you could make money scalping. Yes, you could make money, with in and out trades. Yes, you could make money with swing trades. But realistically, at the end of the day, the market never loses because the premium sellers, knowing that the odds are in their favor when they collect premium, they just like to sell options. Good morning, Alex. How are you? Thank you for joining. If you have any questions, please send it to the chat. So why does this level hold? Why do these levels, matter to us? If institutions have trillions, and I'm talking with a T, of money in between these levels, that means that as long as the price stays here and here, those options that they sold keep decaying every single day. And I'm not talking about 2 options, 3 options. I'm talking about 1,000 contracts, 2,000 contracts. I'm talking about iron contracts. I'm talking about verticals. I'm talking about stratos, strangles. All these contracts that are being sold, that are being bought by traders, are being sold by institutions. And as long as the price stays within these levels, is like they hear the little money machine going every morning, ching, they're making money. So on Tuesday, when the market opened with a huge gap to the downside, I know a lot of people honestly thought that the market was going to keep dropping. If you didn't know that the market have moved in a day, which is Tuesday, what was supposed to move in a week, then you got caught. You got caught short. And that's basically what happened to a lot of people. I will take this to a 30-minute chart, and we will look at the price action for Tuesday. So this is Tuesday. Market close on Friday. We're looking at the SPX. Huge gap down to the downside. And I will explain why you would see the gap on the SPX that you see on the ES, even though they're backed by the same product, but they're not the same. This is a cash product, only operates during regular trading hours. The ES futures, the S&P 500 futures, do operate on a 24-hour market, so that's why there's a cash differential, but they pretty much follow each other. This is the one that leads the way. The XPX leads and the ES follows, and I'll explain to you why in a little bit. So we open with the gap down. Jazz, good morning. Thank you for joining us. Elijah, good morning. Thank you for joining us. Any questions that you have, please send it to the chat. Market open on Tuesday, gap down, slammed against the weekly risk marker. This was the risk marker for the week. This was supposed to be done in about a week. We did it in 1 day. Unless there's something catastrophic happening in the market, unless there is a catalyst, what we like to call catalyst, the market, the algorithms in these trading companies, which are, they're holding billions and trillions of dollars in between these levels, they will drive the market back inside that range. Because remember, the minute the price action, the minute the market falls out of these ranges, those institutions are actually losing money and they need to hedge their bets. What is hedging? It's just another word for insurance, basically what it is. See, when institutions trade, they cannot simply just go out and close the positions they have. They will literally just kill the market because everybody will see them coming. And we're talking about trillions of dollars in orders, billions of dollars in orders. And a lot of institutions, you'll be amazed, they don't trade stock, they trade options because there's only, as many people would like to believe, there are a limited number of stocks out there. Companies issue stock and it gets bought, it gets traded, and people are holding it. So the only thing that they can do is trade options against those stocks, or trade options because we never actually own the stock. We only own the right to own the stock at the expiration of the option. Algorithms basically took it right back inside. That's exactly what happened on Tuesday. If you had no idea this line existed, everybody was waiting for the pullback. Oh my God, here it is. Again, technical analysis, high, low, higher low, higher low, lower low, higher low, and everybody expected the market to drop. Oh my God, momentum was high. Guess what? The market didn't drop. Why? Because this is the happy place. This is where the money is made. Again, we closed. Basically was kind of an inside day. It was an inside day. Market opened with a gap up on Wednesday. Tested pretty much the levels of Tuesday. And we drove up again to the closing. This gray line is the closing. Again, if I say funky color names, don't mind me. I'm a little colorblind. So I may look to you like an orange or a yellow or a green. It might look like a pink or a purple to me. So just bear with me or just kind of correct me. Closing price for the week, for Friday, market came right back to it. And we said it in the live yesterday in the morning with Trades in the Market. I said, well, if this market opens, we're probably going to test the level from yesterday. We're probably, and this was actually the settle that we tested on the ES. We're going to go test the weekly pivot because this was a weekly pivot, and we're going to go test the settle for the week because this was the settle for, because the SPX does have a settle price. I will talk about settle prices in a little bit. What is a settle price? Let me make myself a note. It's Friday. I'm having coffee, but you know, it's Friday. I really want to think. And guess what? Here we go. What do we have left for the week? Well, if the ES tested the overnight high, guess what? There's a high probability that we're going to test this. Why? Because remember, as the SPX does, so does the ES. But being that the ES is a 24-hour market, what we see here is that the ES already made a new high, and the SPX was left behind here yesterday when the market closed. So let me change this for, well, these are, well, you guys, we're going to talk about this type of charts in a little bit, so we'll just leave it here. Where are we going to open today? Well, are we going to open with a gap up? Are we going to open with a gap down? We're going to open pretty much where we closed yesterday. Closing price yesterday, you know what, let me change this for you guys because I know you guys like to work with candles instead of bars. I work with bars, but we will cater to the majority so you guys win. I change this to candles. And Elijah knows how I feel about candles, don't you? Victor Myers, good morning. Thank you for joining us. Any questions that you have, please send it to the chat, or you also have an email, info@dailytraders.com. Anything that you guys need to know about the company, about the training, about mentorships, send me an email and I will be more than happy to answer. I do answer all emails personally. So here we go. 1600 hours. We closed at 65.14. Are we going to open with a gap? If the market were to open right now, we will have a very small gap to the upside. We're having actually economic news coming about in 5 minutes. So the market is actually slowly drifting to the closing price. So the SPX is not going to have a gap to the upside unless for whatever reason at 8:30 this thing shoots up to the upside again. And then you will see that that gap to the upside on the SPX as well. And this is your all-time high on the SPX. So it is very close. So there is a high probability that these high prices are going to be tested today and the market will just drift from there. Rule of thumb, one of the things that you guys need to know, and this is if we test an all-time price in the regular market hours, always, always, always check your volume to see how the price was hit. Remember, an all-time high is like driving a beetle into a concrete wall. You need strength to break it. You need volume to break into, to test that level. You need momentum to break into that level. So if you actually see that level being broken with volume, guess what? Jump on it, because more than likely that price is going to keep running. The market is emotional. Traders are emotional. We have long-term traders, which are your institutions. We have short-term traders, which are your scalpers, your short-term traders, trading desk. They're both trade different ways because they have different, what's the word, different goals for trading the market, okay? But that is one of the rules that I tell people. If you see an all-time high being broken on volume, on a regular trading hours, jump on it. I mean, you got to do it. So market is fading back, and we're pretty much testing the close from yesterday. And okay, so we were talking about that. Mentioned something about settle. What is a settle price? Market has what you guys see as the closing price from yesterday, especially in the futures market. 1600 hours, that was the closing price. When it comes to the futures market, people always ask me, why do you always talk about the futures market? Why don't you talk about the SPY or the QQQs or, I don't know, the Dow Jones? You need to understand one thing. There's a hierarchy in the market. The highest thing that you have in the market is your indices. What is an index? It's basically, you could say it's a company that tracks the movement of different stocks in different sectors. You have your economy, you have your financial, you have your technology sector, you have your goods sector, all kinds of sectors. At the end of the day, all these companies that make up those sectors, they belong to one of the big indices, either the S&P 500, the NASDAQ, the Russell 2000, or the Dow Jones. There are other indices like the Russell 3000, and they have the S&P 400 and S&P 100, but we concentrate on the S&P 500. Why? Specifically the ES, which are the futures contracts for that index, for the S&P 500. Because the whole world uses the ES to lay off risk. What does lay off risk? Cody, good morning. Marley, good morning. Thank you for joining. I lost my train of thought. What does laying risk mean? It means that, like I mentioned before, institutions are always invested in the market. By law, they cannot have $40–50 million of people's money laying around, just waiting to see what happens in the market. They do have cash reserves, but they do need to trade. They need to be in the market. And we all know that the market has an upward drift. So yeah, market goes up, market goes down, market goes up, market goes down, but eventually it keeps going higher. When the market drops, when the market is trying to shake out weak hands by dropping, institutions just cannot close those positions. So what do? If we're positioned to the upside, market's coming down, we lay off risk, meaning that the money that we may be losing in those positions that we had to the upside, we're going to mitigate by selling futures contracts. If you sell something to the downside, you are making money if the market is down. If I had positions to the outside, now that loss, maybe not all of it, but most of it is being mitigated by me selling futures to the downside. Institutions have computers, algorithms that do this in milliseconds, and they compute how many futures contracts do I need to sell if I have a $60 million position that is underwater now by X amount of dollars. It does it, on the fly. That's why I'm not going to say that I'm against scalping, because I do scalp, when the market, lends itself to it, or pretty much when I'm bored and there's nothing to do. But it is amazing to me how many people think that they can beat a computer. By the time you press the click on the mouse button, the algos have already traded probably 1,000 times in milliseconds, and we honestly came up and we're breaking the close from yesterday. So news is coming out right now. Let's see, what do we have for news today, and I'll come back to that, because that is another thing that we look at, and I get a little carried away. I like to talk, I like to teach. So what did we have today for news? Specifically, Catalyst at 8:30 in the morning, which are usually when the news comes out. Let's see. We'll be able to look at this stuff on the computer next week. I am a virgin at doing lives, so don't mind me. Let's see. What did we have? Unemployment rate, of course. Non-farm payrolls. Average early earnings. Oh gosh. And apparently the market did not like. No likey. U.S. employment rate, and then at 1 o'clock we're going to have a oil rig count. That's also a big one if you trade oil or any type of energy stock. But yeah, private non-farm payroll. So whatever came out, that's what it was. Why don't I care about the numbers? Because the numbers are going to be changed in 2 weeks. If you don't realize, a lot of these numbers that come out, we test the reaction of the market. How does the market react to it? Did they like it? Did they not like it? But you also take that with a grain of salt, because in 2 weeks they're going to be what? They're going to be updated, either to the upside or the downside. So it really doesn't matter. Right now, unfortunately, there's a lot of manipulation when it comes to the economic data, because we are, we're in a slippery slope, and the administration wants to see good numbers, and it's all the political talk you will ever hear from me here or anywhere else, or religion for that matter. So we were talking about what the heck were we talking about? Anybody can remind me, because I forgot. We were talking about geez, I need more coffee. What were we talking about? Come on. Was anybody else paying attention? Because obviously I wasn't. Let's see. Risk markers, we're talking about the SPX, and we were talking about how institutions trade. I think that's what we were talking about. Anyway, when it comes to the SPX, that's what we followed, because we're talking about laying risk. Why we use futures? So when we come to hierarchy, indices, futures, we have like your indices. Then those indices have futures contracts that they're traded, because you cannot buy or sell an index. People say, yes, you can. Look, I can sell an index. Well, guess what? This is the SPX. If I click on me wanting to buy anything, guess what? It's grayed out. You cannot buy or sell an index. But you can trade the options on the index. So let's say, for example, you're looking at something like the ES. We're looking at something like the SPX. So let's do a little song and dance here, so you guys have an idea what I'm talking about. I'm going to put 3 charts. Look how good that is. So here's your S&P 500 index on a daily chart. I will put here your futures contracts, and to be fair, it is on a daily chart, and I will take off the extended hours, so we're comparing apples to apples. This is your SPX. This is your index. This is your ES. This is the futures contracts for the SPX. And guess what? Here's the SPY. What is the SPY? The SPY is the ETF for the S&P 500. ETF means Exchange Traded Fund. Okay? There we go. Thank you, Elijah. At least somebody was paying attention. Because not even the guy that's doing the live remembers. Wow. Anyway, here you go. I don't know if you guys can tell, but these charts are pretty much a copy of one another. Why? Because they track the same product. You're just trading different products, but you're trading the same methodology. You're trading the same thing that's going on in the market. You're trading the index. That is not true. Okay, here we go. NDX. What is the NDX? That is the index for the NASDAQ. No, it's not. It's the QQQs. I guess it is. Look, the NQ is the futures contract for the NASDAQ, for the NDX. And the QQQ is what? It's your ETF for the NASDAQ. So if you look at it, you're saying, what the hell? It looks the same, because you are trading basically the same product. Companies make products that track or mimic an index. For example, the QQQs, this belongs to a private investment firm. The NQ futures are being done by the CME group. So there's different companies, and you will see that in this business, stocks, indices is basically just product. I mean, at the end of the day, I've said this before. When you learn this business and you do more than just scalping or just intraday trading, when you learn how to handle a small portfolio, which should be your goal. I don't think you want to be 60, 70 years old, sitting in front of a computer, trying to do intraday. But the goal should be for you to learn how to trade a small portfolio. Maybe not small, maybe it gets big, but you need to learn how to control inventory, and that's basically what all this boils down to. You become a glorified manager of inventory. What's paying me? What's not paying me? What do I need to sell? What do I need to buy? And like I said before, it gets boring. Why 3 different products? It all has to do with risk. your risk. What are you comfortable risking? Because again, we're going to go back. We don't trade the NDX options. Why? Because there's no liquidity, there's no volume in it. It's a dog, nobody cares. We don't trade the Dow Jones. Why? Because it's only 30 companies. 30 companies don't tell me anything about the economy or the market. Why 500 companies? Because they are the biggest companies in the market. They are the biggest company when it comes to market cap, your blue chips. So guess what? That's where I want to go, because if I want to see where the market is going, if I want to see what's taking the market up or down, is going to be those 500 companies, because you don't want the tail wagging the dog. So when we come to risk, let's have an idea what we're talking about risk. SPX. We just looked at an option for the SPX. We figured that it was what, like about $2,400. Elijah, what is Aiden? Thank you for joining. Welcome. What is a small portfolio? That is all subjected to your account. I mean, a small portfolio could be $1,000, and you buy, you buy options on the XLF, which are pretty cheap. You could buy options on let me bring this up for you guys. Where are my sectors? Sectors. Here we go. These are your sectors of the economy, the main sectors. Here's your financials. Yeah, it's $53. Here's your XLK. This is technology. Here's your consumer, not discretionary. Oh my God, come on, help me over here, somebody. Consumer discretionary, consumer staples. Here we go. This means that this is the stuff that you want to buy, and the XLP, which is your the consumer sector, this is stuff that you need to buy. I would need a car. I want to buy a Mercedes. You come down here, shit, I need a car. I'm just going to buy myself a Chevy because that's what I can afford. Big difference between these two. Then you have your industrial sector. You have your energy sector, building materials. Again, consumer staples, healthcare, and utilities. These are the main, I know there's more sectors, there's a ton of them, but these are the main 9. So when I'm talking about a small portfolio, you could get some XLF. You could get some consumer discretionary, staples. You could get some healthcare. And remember, you're going to be doing this with the options market. You're not necessarily going to be buying the stock, because for that, then you need more money. So a small portfolio could be anywhere from 5,000 to 10,000 to 25, depending on your level of risk and your level of expertise handling that portfolio. When you become more proficient, then we're talking about more money. Again, it's all relative to the amount of money that you have or that you feel comfortable trading or risking. So let's do the comparison when it comes to risk and why people trade different products. SPX, we looked at the SPX. We look at this option right now. Not that one, because that one is going to give us, let's say, I'm at the XLF. Look at that. I'm in the XLF. Let's unlink this and let's do the SPX. I was going to say 91 cents for an SPX contract. I'm going to buy me 10 right now. It's a bargain. Here we go. SPX. What does one contract cost you? $2,400. Are you comfortable risking $2,400 in one contract? If the answer is yes, go for it. If the answer is no, this is not the product for you to trade. Because when you risk more than you're comfortable, you will make stupid decisions. I'm sorry, that's just the truth. You will make stupid decisions because you will get out when you don't have to, you will get in when you definitely don't have to, and you will revenge trade until you blow your account. Why? Because you're risking more than you should. You're not comfortable with that level of risk. This is one thing that I say, and Elijah knows this. If the position you're putting is keeping you up at night, if it's making your hands sweat, if you can't sleep, if you can't eat because you're thinking about the debt market and your position, you're trading too big. Step down. This should be like a funeral. You put the position, you did your analysis, whatever it may be, technical, momentum, whatever you want to call it. What is it? That's the thing that, whatever it is that your analysis is. But you need to understand that at the end of the day, once you hit the send button, you're at the mercy of the market. It's plain and simple. The market's going to do what the market's going to do, and you do not have any control over it. You need to learn the basic truth, otherwise the market is going to humble you. So $2,400 risk in the SPX. Are you comfortable? Yes or no? Good morning, everybody. Crypto, Alex, Dionis, good morning. Thank you for joining us. Any questions, please send it to the chat. Azul, thank you for joining us. Good morning. So, risk, $2,400. Comfortable, yes or no? Maybe the answer is hell no, because this thing moves quick. This thing's about $10 per tick, meaning that for every cent that this thing moves, you're going to be making or losing $10. That's a big boy. Let's look at now at the next product, which would be the futures, the ES. Yes, you can trade options on the futures contracts. Yes, the ES is the most liquid market. Let's see what an ES contract will cost you today on the options if you don't want to trade the straight future. Here we go. This is going to cost you $850 for that option. Are you comfortable risking $850 on a single position? Yes or no? It's that simple. Don't look at how much money you can make. In this business, you need to learn to not lose money before you can actually learn to make money. Because I can teach you how to make money all day long, but if you keep blowing up your account, that is a disservice to you. You need to learn how to not lose money. And the first thing you do to learn that is to learn your own limitations. What are you comfortable trading? $850 for some people is like, no, because maybe that's half of your account. Maybe that's 1/3 of your account. If you're starting this business, maybe you have a small account. You're like, guess what? That's too rich for me. All right. Let's look at what a straight contract is going to cost you, because this one you could actually buy the contract. Buy a single contract. Again, this is going to cost you the margin to place a futures trade with the ES is going to cost you about $24,000. Do you have that amount of money in your account? The answer is yes. Okay. Are you willing to risk that? And I know people are going to say, but I can trade futures at another firm with $500. I could do it with $1,000. Yes, you can, but that doesn't mean that the risk is any different. You're still on the hook for whatever the margin that brokers has for the day. There's two different margins, and we'll talk about margin later on when we do a class. But basically, a margin is like a good faith deposit that you need to put with the broker for you to be able to trade a product. This contract doesn't cost $24,000. This contract is asking you for $24,000 to what? To be able to place a trade, and in good faith, they're going to hold $24,000. If you're at a discount broker like Tradeovate or Ninja Trader, or I don't know how many more there are, but there's a bunch of them. Instead of $24,000, they're going to tell you, okay, you know what? Today you could trade the ES with $500 initial margin or $1,000 initial margin. That is a good faith deposit. What the actual cost of this contract right now is a whooping $326,000. That is the notional value. That is the cash value of this contract. Let's say this expires today and you forget to close your position. The broker is going to call you and say, where's my $326,000? Because you own a contract of the ES. That is what I'm talking about when I mean risk. Are you comfortable taking a risk with these big products? People think it's fun and games until you get a margin call. So you're not comfortable trading this. I completely understand. So guess what? You still want to trade the ES? Elijah knows this product. This is Elijah's product. SPY. There you go. The SPY. Most liquid product in the market. There you go. What is an option costing you now? Same option. Add the money. Look. $172. Guess what? That should be comfortable for anybody. Now, if you're not happy or you're not comfortable risking $172, guess what? There's a cure for that. You could always do what are called buy a vertical. This is a directional play, whether you think it's going to go up or you think it's going to go down. This one here is only going to cost you $48. Now, if you're afraid of losing $48, my friend, I will be honest with you, this ain't the business for you. Just go do something else, because this is peanuts. But I just showed you from a hierarchy, standpoint and a risk standpoint, why you need to be very careful by choosing the product that you trade. Yes, it looks nice in theory when people are scalping on the 1 minute NQ and they're like ostriches on crack, just running because that thing moves. That thing is volatile. But is that really the risk you want to take? Are you comfortable with that? And if the answer is no, Arturo, good morning. Kowski, good morning. Thank you for joining. Mom Life. Shiloh, I'm sorry if I mispronounce your name. Lovely. Jamon, thank you for joining. Any questions, please type it in the chat. If you're not comfortable with that type of risk, then don't do it. Don't do the trade, okay? So that is why we look at the ES. It's the most liquid product. It is also the products that companies use to mitigate risk, and it's also the best gauge to see what the market is doing now. The economy, the market. Because remember, the market and the economy are two separate things. You want to see how the economy is doing, then guess what? You look at the Russell 2000, which the ETF is the IWM. That's what the economy is doing today. So the economy did an all-time high back in November of last year and still hasn't recovered. So that's basically, you want to see the economy, you look at the Russell. You want to see what the market is doing, you look at the SPX or the S&P 500. Now, let's go back to the ES and let's trace some levels for today. Let's see real quick here what our risk for today would be based on the options market, not a SPY. Where's my SPX? Right here. Based on the options market, it tells us that today, let's see, today is the 5th, we should have about, okay, it's going to be about $69. So we're going to go down to our 30-minute chart. We're going to bring up some drawings, and here we go. So I see there was about $69 for risk for today. That is based on the options market. That's what they say. We should move about $69. It just doesn't give me a direction, you know, either up or down. That is for us to kind of decide. So where is the closing? Here's your closing. 65.14.21 is your closing. So 65.14.21. Again, I'm doing what we do every single morning, so just bear with me. 2 plus $69, that is 65.83.21. So we're going to duplicate this one. We're going to edit the properties, today's date, and it's going to be 65.83.21. And that is the level of risk that the market says that we should have to the upside. And now we're going to do the level to the downside. 69, 69, that is 64.45. So we're going to duplicate. We're going to edit, take it. We're going to change the date, and it's going to be 64.45.21. And we're going to click OK. Well, there you go. That is the risk for today, according to the options market. We can either go as high as 65.83, give or take, or we can go as low as 64.45. Okay. Settle. We talked about the settle. We have about 15 minutes, 10 minutes or so. Let's talk about the settle. The price that you guys see in the futures market at the closing price, which is here. Closing price is 65.14.25. That is the last price that you see traded in the market. Again, we talked about margin before, and margin basically states that what you need, this is the amount of money that you need to have to be able to trade a specific product when it comes to the, you know, any market. The settle for the ES yesterday was actually 65.10.75. Why 65.10.75? I don't know. And we'll explain it to you. When the market closes, specifically the futures market, you were either trading in a cash margin for the day, like an RTH margin for intraday trading, which is less, 500, 1,000, 1,500, whatever the broker may be. That is a discounted rate. When you step from 6 until 9:30 in the morning, the majority, not all, but the majority of brokers require you to have the full margin amount in your account. Meaning that if you're going to be trading the ES and you're going to be carrying any position overnight, you need to have your full $24,000. Yes, there are micro contracts. Yes, there are contracts that are 10 times smaller than this, and the requirement is 10 times less. So if you're going to trade the ES, then instead of needing $24,000, if you're going to trade a micro, you trade with $2,400. Nevertheless, the risk is always there. Remember about your notional value, not how much money you're risking in your account, what the margin is. So why the settle? When the computer realizes, this is all done by computers, by the way. When the computer looks at all the transactions that are open, what we call the book of open transactions, before that book gets transferred to Europe, because they do that. I mean, like, this is what we have open. This is what you got to continue, because this market is a continuous market throughout the world. And the nice thing about futures, there's no manipulation. You could be here, you could be in China, you could be anywhere, and the market and the price on the screen has to be the same. It's going to be the same everywhere in the world. Not a tick of a slippage or difference. If they see that a lot of those positions don't have the margin requirement to carry that position overnight, you either get a margin call, which they tell you, look, buddy, you only have $10,000 in your account, you need an additional 15,000. Well, why 15,000? If it's the margin is 24, because there's also maintenance margin, and we'll get into that later. So you have initial margin and maintenance margin for these products. But let's just say they ask you for an additional $10,000. If you don't have it, they will literally close your position. More than not, a lot of these positions are losers because people are thinking, well, maybe tomorrow is going to go higher, or maybe people are making money and they want that overnight action because they think it's going to keep going their way. Wherever that position is closed, that is going to make the price fluctuate. So instead of you having that closing price or whatever it was yesterday, 60, I keep forgetting, closing price, it was 65.14, that's going to make the price fluctuate. You won't see this unless you're looking at the aftermarket, but that's why the settle is so important. Because if you look at this line right here, the one that I just duplicated, that was the settle price that we had for the third. And you can see how the market respected that settle price, because that's where the market finally, when all those transactions were closed or margin calls were made or met, guess what? That's where the actual final price settled. And that is a strong level. So guess what? We trade strong levels, correct? So the settle price is going to be, what did I say, 65.1075. Next week I will show you guys the websites where you can go get all these numbers if you're interested in trading this way. 4 and 5. Is that what it is? Yes. So, oh, look at that. What a coincidence. When the market dropped at 8:30, where did it stop? Came back down, tested the close, right over the settle. And guess what? We're actually making new highs right now. If you didn't know this level was there, you had probably no freaking clue what was going on there, unless you go to like, oh my god, let me go to a 1 minute chart. Well, guess what? There was nothing there, but guess what? There was your settle. Oh, it was the wick of this candle. See, look, it was that candle. No, it wasn't. It was the settle price. All right, let's call it what it is. So right now I have pretty much what do I have? I have a roadmap for my day. I know that we could go, if we keep going after the high, which we are going to be testing in about a half hour again. This is a news bar in, I'm sorry, I forgot to change this for you guys. Here we go. This candle, to me, it's very iffy. Why? Because it was made out of a news announcement. Panic, then all of a sudden everybody get happy again. That would be my overnight high. My overnight high is for today is going to be the all-time high that we did at 2 o'clock in the morning when the DAX opening in Germany. This might still be going higher, and I will keep this range in mind if the market decides to drop back inside. Okay, so as you can see, what did we do this morning? We basically, good morning, Peridos, Furgan, Angelique, thank you guys for joining. Any questions, please send it to the chat or to the email on screen. This right here is going to be like a range that I'm going to keep in mind in case we drop back inside. If we drop back inside, then my next level to test again is going to be my settle from yesterday. And if we drop, then guess what? We're going back down to the weekly pivot. This is the weekly pivot. It's a very important level. If we go back down, then we're going to test the settle for the week. And if we keep going down, we're going to do what? Go for the risk marker. So the market moves in levels. Levels are magnets. Anything that you do, the market is going from one level to another level. Okay. Any questions? Please let me know. I know I talk a lot, but guess what? I like this business. I like to teach. I like for you guys to learn the reality of how this market works. Why am I not trading? Because I don't have to trade. I trade when the market is liquid. I trade when the market gives me the opportunity to trade. I'm not looking for a trade. I am waiting to see if the market is going to do what I think it does based on the analysis that I just did. There's my overnight high. When I open, am I going to shoot up and go for the risk marker, or am I going to go test and then fall back down? If the market tests and it falls back down, guess what? That's a short. Why? Because the best place to place a short is if an all-time high fails, because you're going to go what? Slam against the all-time high. That's a high probability trade. If the market goes up, falls back down with volume, what is the next trade that I am waiting to see if the market gives it to me? From the previous all-time high to what? To my seller from yesterday. See, I am not looking for a trade. I already know what I want to see in the market for me to trade, and you need to be patient. If you go looking for a trade, you will find a trade. That's just the nature. But if you wait for the market to show you what you want to see, those are what we call high probability trades, and you want to be trading from that perspective. Now, we trade market time charts. You probably know this as market profile charts. And people out there trade it like if it was technical analysis, and it is not. Yes, you have different components to this, but when you look at candles, you're getting only a two-dimensional view. You're looking at price and you're looking at volume, okay? And you could say time as well, because every single candle, this one for example, a 30-minute, is going to close every 30 minutes no matter what happens, okay? When we're looking at this type of chart, it gives me a better idea of number one, who am I trading against in the market? Is it a short-term trader like an intraday trader, or an institution that is basically trading in the smaller time frame? Or am I trading against an actual institutional traders? And the market does show you that when you learn how to read these charts. We don't trade price. Again, like I mentioned before, price is just an advertising mechanism like any store. What do people do to incite you to come in and buy? They lower the price. They give you a sale price, 20% off, 50% off, but you're always looking at price. But where's the value in that? Value is what directs the market. Value is what drives it, and we are value traders. We look at value, we look at momentum, and we look at time. So, because price is an advertising mechanism, volume confirms or denies the action that you're seeing in the price, and also the time that you trade has a lot to do with the type of trading you're going to do. You cannot expect, unless something happens, the same movement at 1, 2 o'clock in the morning. Well, 2 o'clock in the morning maybe because the AXIC's opening. But maybe like around 8, 9, 10 o'clock at night that you would see at 9, 10 in the morning. It's a completely different market, completely different people trading. So if we look at the profile from yesterday, value did go higher. We do have a couple of single prints, meaning that these are areas of fast movement if the price does decide, if the auction, because now we're going to call it an auction, not the price, if the auction decides to come back into these levels. Let me make this a little bigger for you guys, and we have about 2 minutes to go, and we're going to get more into this next week. So value right here from Tuesday, Wednesday, Thursday. So value is going higher, but the shape of the profile is telling me that this was not done by institutional traders. The move from the risk market for the week was done by the institutions, but the rest of the flow was basically done by people that were either long the market and they were cut short, so all those positions have to be brought back. There's a lot of indecision in the market, and this profile is very truncated. There's a lot of anomalies in it, and I'm not going to get into the gist of it, but basically this tells me that there's a lot of imbalances in the market, in the order flow, and the market does come to correct those. This also tells me, if you look at, I have a drawing called range markers. We are in a range. We're still in a range that we were basically, this is the bottom of the range, 63.59.87. And right now we're heading back to the top of that range, of course, because the all-time high was here before. So now I have another thing that I'm going to look at throughout the day. I'm going to be looking at these range markers to tell me if I go higher, yes, I'm going to go with the market. But if I start stepping back inside, I need to see a value actually starting to drop again, and we're going to test all these markers again. So you see, I'm not looking at at price formations, and the reason why is because probabilities don't work for the past. Probabilities work mostly for whatever's going to happen in the future, and we look at the options market for that. And I'm looking at what the probability is of us hitting these levels, and the market tells you. If the market does tell you, But the most important thing is that I need to know what my levels for today are. And these are my levels for today. I'm going to have my open when the market opens. That's going to be an important level for us to keep an eye on. I have my settle from yesterday. I have the all-time high that we did overnight. We have the overnight high, overnight low. We also have something called half back, which is about 50, where this is the profile for the overnight. If you see this here, this is the overnight market. We have good lows. We have a very prominent point of control because there is a point of control, but value is very tight. That tells me there's a lot of indecision in the market, even though we did make that all-time high, but there's a lot of indecision in the market. This is not institutional trading. Institutional trading looks a lot like this. See, there's a lot of movement. Learn one thing, if you learn one thing today from this live, before we finish, short-term traders, we're talking about scalpers, we're talking about, not investors. They do not move the market directionally. They're basically looking for a happy place where they can trade back and forth, buy, sell, fill orders. They want that happy place. Institutional traders or long-term traders, we're looking for opportunity. Opportunity what? Half of these people don't give a crap about the levels. More than not, they don't know where they are. They don't care where they are. They're looking for a chance to make money, to fill orders. Something that they see as an advantage for them to either buy or sell at this specific price, at this specific level in the auction, because to them it's going to be advantageous in the future. So always keep that in mind. Short-term traders, scalpers, intraday traders, intraday trading, if it's done by the short-term investor, the short-term trader, does not move the market directionally. Institutional trading, long-term traders, they move the market directionally. And you will be able to see that when you see these charts. We do have classes on this. If you guys are interested in learning more about this, shoot me an email. All right, it's about 9:03. So what am I expecting for today? Again, like I said, I have an all-time high that it's going to get tested. I have a very good idea. I have a very good feeling that it's going to get tested. Will probably come down to retest the previous all-time high. And again, if we break below it, all hell's going to break loose. We're just going to come down and retest all the levels that we had from yesterday. If we keep going higher, it's going to be another what we call a trend day or an outside day. And again, keep in mind your settle, your daily risk markers for the day, your high and your low. And I am going to keep in mind that I am in this range in the market. If I look at a regular chart, here are the lines. These are the lines for today. This is the range markers that we're in. So here are the lines, and there's okay, we're not going to get into this. And these are my monthly lines for the month. We'll probably talk more about this next week. All right. It's about 9:05, guys. I will let you go. I will be trading live in the chat room that we have in our page. We do trade live there from 9:30 until about 12 o'clock. Then we do come back around 3 o'clock to close the market. If you guys have any interest in joining that, again, shoot me an email and I will be posting more about this stuff out here on TikTok. You guys have a great day. Thank you for joining us. Bye-bye.